Because we discussed about supply demand and breaks of structure, now we should take a quick look at flip zones. Flip zones are a very important element of our trading because it can consist of one of our entry criteria. So let's say we have bullish structure, something like this. So as I mentioned earlier in the videos, we have breaks of structure to the upside, but we also have demand zones that are getting respected and where we should take entries from. So this is the best area to trade from. Once you get the pullback, you wait for price to tap back into your supply or demand zone, and then you start trading from it. However, there are some instances when price leaves from a flip zone. When that happens, that usually happens when there's a really volatile change of character, and also when we are in session. So when we are in the trading session, for example, London or New York, price usually doesn't really come back to the extreme. So let's say this is the 5-minute structure or the 1-minute structure, because we look for entries on that time frame. Price doesn't really, after you have an aggressive, let's say, change of character or break of structure, price, because it's in session and there's a lot of volatility coming in, it usually just comes back to tap the flip zone and then leaves. It doesn't really come back to the extreme supply and demand zone. So for that reason, we also need to know what flip zones is. So flip zones are the last candle, so just before the break of structure or the change of character. So let's say we have something like this, all right, and then we have something like this. So we have a break of structure here, have a break of structure here. We have our demand zones, so this, and then this one, and you see price never comes back to tap into the demand zone. So for that reason, we have the flip zone. So the flip zone looks something like this. So basically, when price reacts from the previous demand zone and starts building up towards the high in order to make that break of structure or change of character, it can give a nice little reaction. It can form another candle like this one, the last basically bearish candle, another bearish candle before the break of structure. So same rules as this demand zone, but it's higher, and it's the point where price broke the structure to the upside or the downside. So now we have this zone as a flip zone. So a flip zone is called exactly that because it's a zone where price flipped. So when price flipped from going bearish to breaking structure, this flip zone is best used when we have change of character, because we have something like this. All right, we give a nice reaction here, and then price creates that change of character. So you see how here we are bearish, so we have a break of structure to the downside. Then price, let's say, taps a higher time frame demand zone and starts to give a nice reaction. So here you anticipate price after making the break of structure, anticipate price to create the lower high and then continue lower to create another break of structure. What it does instead is give a nice little reaction, and then price breaks above. So instead of continuing lower, you have now a change of character. So price just did a change of character to the upside. So now bullish order flow is in motion. And because usually when this happens, it happens during your session, so during London or New York where price is volatile, you would expect price either to start going really aggressive into your direction or just come back and retest the flip zone. So if you were to wait for this area here, then most likely you wouldn't have gotten an entry. But if you mark the flip zone and wait to enter there, then you have your entry here. And in this case, you're going to have two entries, and you can play it both two ways. You can either play it like this, aggressive, with stop loss just covering the flip zone, or you can play it more safely, covering the low if your target is also higher time frame, and then add another position when price comes there. Now, I usually recommend having a stop loss somewhere around there, just covering the flip zone and a little bit more, because usually when there's a flip zone, you also have an imbalance to the left here, where price can come in and then start going up. So you want to cover for that also. Now, another important thing is to understand what a V-shape recovery is. Another good element when we want to trade a reversal. V-shape is exactly that, when price forms a V-like structure. So that usually happens when price is really bearish and it comes into an area and then gives an immediate reaction, and you can see how the bearish volume is matched by the bullish volume, and it creates something similar to a V-shape, and that is why it's called V-shape recovery. Now, combining a V-shape recovery with this pattern right here means you will have a successful trade, because once you have this drop into the higher time frame, then you have something like this. You have a V-shape recovery which also forms equal highs, so you also form equal highs here. You don't break structure, but you create liquidity, and then you have a little reaction, and then price pumps higher. Then you have equal highs being taken. You have V-shape recovery, you have the break here, and then you have the flip zone where you can safely enter. When you create a V-shape, it looks something like this. it always creates equal highs, then has some kind of reaction, and then it breaks higher, comes back, and then continues. So knowing to identify when a V-shaped recovery happens, and it can happen on the opposite side as well. So you have something like this, right? You have the V-shape, you have the flip zone. After the change of character, you have your entry there. So that combination is really powerful, especially when price comes into a higher time frame zone and when it comes during your session, and you will always gonna trade during a session. So that way we avoid a lot of unnecessary losses. Now, flip zones, as I said, are really powerful. We're gonna combine them with the balances, and then we're gonna go over case studies to understand how they really work and how you can enter trades. But just remember, the flip zone is the last point where price broke structure. So if we take a look at some examples, I think there's one happening right now on EU. So here you see perfect example of a flip zone. You had the low being taken here, you had a break of structure to the downside, and then price created a change of character here on the 1 minute because we came into a higher time frame zone. So you have the change of character to the upside here, and you have the zone, the extreme zone, where price is like, it's the safest option. So you wait for the pullback here, you wait for order flow to realign in your direction, and then you take the trade from there. That way you're gonna have the best risk here. But you can see how price just left without ever coming back. So for that reason, you also mark the flip zone. The flip zone is this right here. So you see the change of character, and this is the last consolidation, the last down candle before the move up. So you can expect price to come back there, and you could have executed in this area and see you've already been in profit 1 to 6, or you can target a 1 to 5 and just take profits. So it's important to understand how flip zones work because they're really good for catching trades when there's a lot of volatility coming in, especially in your session.